Hello and welcome to Car Dealer Live. Now your eyes aren't deceiving you, I am out and about in real life. Now today I'm sitting down with Mark Lavery, the CEO of Cambria Automobiles. It's very timely we're having this chat because Lavery has recently made a takeover bid for the company worth £82.5 million to take it private. The offer comes as Cambria celebrates 15 years since being formed by Lavery himself. It operates under the Doves, Grange and Motor Parks brands and represents manufacturers including Rolls-Royce, McLaren, Aston Martin, Bentley and Jaguar Land Rover. And throughout that period, Lavery was the CEO. Mark, thank you so much for doing this. Thanks for inviting us here to this fantastic Grange Jaguar Land Rover dealership in Hatfield. Now, you've recently celebrated 15 years with the company. I would imagine the past 12 months have probably been one of the most challenging, so to speak. How's it all been?
Just incredible. If we went back just over a year ago, so best part of 18 months or so, I guess, James, we were given 24 hours to shut the business down, like everybody else in the industry, and it was, at that particular point, we were looking at a life's work potentially drifting away. There was no furlough scheme, no rates relief, and it looked pretty bleak. And I suppose, like most companies, we found ourselves questioning what we were doing every day, how we made ourselves easy to do business with, and what sort of guest experience we were providing. And then, of course, we found ourselves, we'd been listed on the London Stock Exchange just over a decade ago, and we listed the company at 50p, and literally a decade after, in April of 2020, we were down to 33p. And it sort of made you wonder what you'd been doing for a decade. So, and I suppose that's what's really the sort of salient point around our 15-year anniversary, of which just over a decade of that we've been a publicly listed vehicle. We sort of questioned what the future looks like and came to a conclusion that being public hasn't really worked for us.
Yeah, and that's quite a bold thing to say, I think. So let's get down into it then. So why take Cambria Automobiles private?
I think we're in a position when you consider that data from 50 to 33, we think the stock exchange is there to be an efficient vehicle for all shareholders to maximise the return. And I think that it's probably an unfair comparison with April 2020 because of the pandemic, and I think everybody was severely affected in our industry. But then we did start looking and saying, well, what's the share price been for the last 5 years? And that was high 40s to low 50s. And we thought, well, hang on a minute, there's got to be something fundamentally wrong, because when we were listed initially, we're a significantly smaller company, making significantly less money with a significantly lower value balance sheet. We spend a lot of time and a lot of money being listed. And sort of myself and the directors were questioning, well, if it's not working for us, then can it be working for other shareholders? We came to the conclusion that actually, no, it doesn't. So what do we see the future as? And we spent a bit of time looking at that. And from a personal point of view, my family's the biggest shareholder. We decided that Cambria would flourish better in a private environment than it would do in the public domain. Hence, we find ourselves in the position we find ourselves today, which is, yes, quite busy.
Busy is one way of putting it, I would imagine. Now, do you think why has this situation happened with the stock exchange? Is it a fundamental flaw with the stock exchange? And could you see more listed dealer groups actually having similar conversations which you're having at the moment?
Well, I think there's a couple of things, James. I think first off, you know, there's some great public companies in our space that are listed. Marshall Motor Group, Dash and his team do a stunning job. I think Robert Forrester and his team at Vertu, absolutely spectacular. Obviously Pendragon very much in recovery mode, but Bill and his team look to be doing really well. And Lookers have obviously had a difficult time recently, But again, Mark and his team look to be doing a great job, and it's recovering. But they're all monster businesses, James, of sort of 2, 3, 4, 5 billion turnover. Cambria's got no ambitions to be that size, and a lot of what we want to do in the future is not motor retail related. So you actually find yourselves in a position where it's pretty pointless considering those initiatives because we're listed as a motor retail group. And that's probably the main decisive point where we thought, well, it doesn't make any sense for us, for me personally as the biggest shareholder, but for other shareholders as well. Unfortunately, it's just not worked out as an efficient instrument at this point and over the last 5 years.
Yeah, we'll come on to the future in a second, but let's just talk about the benefits of taking a listed company off the stock exchange and going private. So what do you think those benefits are?
I think flexibility primarily. Flexibility to be able to do things outside motor retail, which we see various aspects of the group from the property point of view, from SOGO's point of view, from repair and maintenance plans point of view, that we can really develop. But there's no incentive to do that because we're listed as a motor retail group. And I think that the circumstances, we've tried to listen to as many shareholders as possible, and in certain cases they've intimated that they'd like to be part of the private company. So we've actually allowed that in both the scheme document and the takeover document, that people can carry their stake into the new entity and potentially benefit from what that looks like. So what we've tried to do is give a fair and reasonable offer, supported by Rothschilds, supported by the independent committee, which is frankly the main board minus myself, because I'm obviously conflicted.
Now, so let's just sort of scoot back in time. So 4 months ago, the news came out that you and James Mullins and Tim Duckers offered 80p a share. Now, as of last week, you're now the sole party in the negotiations, and you've offered 82.5p. Was the first offer a bit too low, do you think?
Well, I don't think anybody should underestimate, James, how unpopular motor retail is with the banks and institutions.
Really?
It's not been an easy deal to get financed, okay, first off. Second off, it's not a competitive bid situation because there's no other bidder. And as I said earlier, I'm not a seller. So we did listen to shareholders, and one or two suggested that wasn't their ideal outcome. Hence, I made the decision to increase that offer to basically as much as we could get financed and afford. And actually, it's, we notified the market in Q1 this year. We were thinking of making a bid. And frankly, that's the only time where we've seen the share price get to the sort of levels it is once we've shown an interest. So we hope by moving from a scheme to an offer, by increasing the offer proportionately, that it's enough for most shareholders to say this is a good idea. Listen, we understand that in any takeover, not everybody's going to be happy all of the time, but what we've tried to do is find a balance and happy medium.
So why do you think the financing from the banks has been difficult? Have they been looking at the past 12 months and saying this is the waters are choppy at the moment?
I think they've looked over the last 3 years, James, and if you look at even the big guys in the sector, they've had their facilities reduced substantially. And when the regulatory authorities are warning the banks off motor retail, just at the time when we were considering a bid, it has made things very difficult. So I guess a unique set of circumstances where we've tried to find the best balance to keep the majority of the shareholders happy.
Yeah. Now, you need at least, I think, 75% of shareholders to agree it. Where are you at the moment? And for the investors who are, perhaps haven't agreed to it yet, why should they support you?
Well, we're at 65.8% of shareholders, including my own stake. 4 of the biggest 5 shareholders are supporting the bid today. I think in a number of cases we found with the scheme that a number of shareholders didn't actually know that we were making a bid. which makes it, and this is a learning for us as well, James. So because the shares were held in either a proxy account, on a platform, or in a nominee account, the underlying shareholder didn't understand that there was an opportunity to realise value. Hence, we had to adjourn the court meeting, and from adjourning the court meeting, we chose to go to the takeover offer, which hopefully we can get to more shareholders and explain to them exactly what is happening.
Now, as we know, shareholders are one thing, manufacturers are quite another. So, I mean, let's just talk about the manufacturers. I mean, Cambria's got brands such as Rolls-Royce and Bentley, Aston Martin, of course, Jaguar Land Rover. What have they been saying to you? Are they supportive of all this?
Really supportive, to a point where really quite humbling with how positive they are about coming out of the public domain. The business has fundamentally changed over the last 5 years as we've moved away from volume and more towards that high luxury segment. And that's not really been recognised by the market, which is another reason why we think the private route for all shareholders, and let's be clear, for the other, shareholders set our share price. We don't. We communicate to the market, we present to the market, we spend an awful lot of time talking to the market and shareholders, and it's them who've set the price. And after a decade, us who've thought, maybe this isn't too efficient for all shareholders, hence we've come up with the offer we've come up with.
From a manufacturer perspective, do you think they prefer to have dealers in their portfolio which are listed and private, or a mixture of both? I mean, what are the advantages, do you think, of being private?
I think very much a mixture of both. I think if you're private, there isn't the same level of pressure to perform to a given number. In the public domain, if we miss, we have to tell everybody we're going to miss, and that has a direct impact on what happens to the share price. So I think that's why the regulatory authorities warned the banks away, and that has that's put us in the position where we think it's a better approach for everybody moving forward. But I think to answer the question, the manufacturers prefer a balance of both.
Yeah. What do they think about your offer?
They're very supportive, hopeful we can get it over the line as quickly as possible, and hopefully we can get on with the rest of our lives at the end of Q3, all being well.
So I would imagine from a manufacturer perspective, they just want this done as quickly as possible, don't they?
And let's be clear, our first responsibility in our company is the associates who work here. The second responsibility is our guests, customers, and making sure we can serve them in an efficient and open manner. The third responsibility is to our brands and making sure we give them great representation points with a great customer service. And actually the fourth responsibility is the shareholders, and we have to operate in that manner. And for the associates, guests and brands, we think there's far more benefit in being private than there is in the public space.
Interesting. So why are you the right man to take this business private? Well, you've got free will to be as arrogant as you like. It's fine.
How rude! The very thought, Mr. Batchelor. Well, Cambria in its modern iteration is Mark Lavery. When we did our first acquisition now 15 years ago, what was then Swindon Automobiles Limited and Sudbury Swindon Limited, tiny little business, was a £10 million turnover site on the edge of bankruptcy, and we took that business from the year before we purchased it had a £750,000 pre-tax loss, and in the year after acquisition, turnover went from 10 million to 27 million, and the £750,000 loss went to a £100,000 profit. Now that was year one. From there, by year 10, we'd taken that £100,000 and turnover of 27 million to turnover of just over £500 million and a pre-tax profit of just over 10 million. So we'd increased profits 100-fold and we'd increased turnover substantially. So I hope that mine and my management team's credentials stand up to external interrogation.
So let's just look back over the last 15 years then. So, how do you think the business has developed during that time? Have you been able to do what you wanted to during that time? And also, how do you think motor retail has changed? Or is it only really changed very recently?
Wow, how long have we got? I think the business obviously set off from very small beginnings. We're bigger now, obviously substantially bigger. The original brand partners were Citroën, Seat and Jaguar. We now have obviously significantly more brand partners. The change in the space in 15 years, James, is frankly just amazing. We've all got to be omni-channel now to be relevant. I think back 15 years ago, our shop window was our shop window. Yeah. And when we did our biggest acquisition to date, which was December 2007, where we bought Summit Motors Investments UK Limited, Summit had a website that didn't work. They shut on a Sunday, which in certain cases I understand, and they wouldn't sell anything that was a non-brand used car. I mean, you just can't survive like that anymore, James. So I think we're arguably going through not a once in a generation change, but once in a century change with the move towards battery electric vehicles, with a potential move towards agency that in certain cases doesn't appear to be agency. And I think that one thing's absolutely certain, we're not going to be short of things to do over the coming time frame. So I think the face of the industry has changed completely, and it's going to change more so. I think arguably we'll see more change over the next 5 than we have in the previous 100. Yeah. So it's an exciting time to participate.
Yeah. Let's just quickly talk about agency sales, because do you think we're in a position where dealers don't quite understand what the agency model is? And from a manufacturer's perspective, do you think they're being open with dealers about the benefits and, of course, the downsides to it as well?
From what I've seen so far, and it's reasonably early and very limited, I've not actually seen a pure agency agreement yet. I've seen certain OEMs suggest it's an agency agreement, but when you check the detail, it's not actually an agency agreement. So I think there's probably quite a lot more to come. I don't see all the OEMs going down the agency route because I think it's a very new model. And of course, an agent can't have a target, he can't have minimum standards to achieve, and he can't be told what his building's got to look like. That is so fundamentally different to the way the franchise dealer system works in this country at this point. And I think the key thing we've got to be conscious about with agency, there's a guest at the end of everything we do. Customer, guest, whatever you want to refer to them. The current distribution system is actually really very efficient and ends up with the guest most of the time getting a really strong deal. Now, I read Autocar last week, and there was a letter of the week from a brand that will remain nameless of a loyal guest to that particular brand who'd gone into a retailer of that particular brand, was told via agency you can't have a discount, was told you can't pay cash, was told that you must be a subscriber, and on that basis the guest walked away from the retailer and said, I won't invest any money in that brand again. Now that for me is very short-sighted, and I think that it'll be a curious time to see who does and who doesn't adopt it, and actually those who think it is an agency with the legislation around it and those who don't. I've not seen a pure agency agreement yet.
Do you think the customer actually cares? As long as they get great customer service and they get what they've signed up for, do you think they really care on what the actual dealership model is?
I think they care about price, and I think they care about efficiency of price and a competitive landscape. And when you're in a position where there is no negotiation on price, there's an argument to suggest that might not be competitive, and it could be classed as a price-fixing cartel. So I think there's a number of areas that will require refinement before it works. For the most important person in the whole supply chain, That's the person who purchases the product. And in a lot of cases, they do still want to purchase the product.
Yes.
They don't want to subscribe to it, particularly of the older generation, that it becomes a bit of a theme to, I pay a subscription and I change it in whatever period I do, because in certain cases they want to buy, they want to own, and want to change it when they want to, not when the OEM wants them to. So I think it's an interesting set of circumstances that has still got quite a long way to play out.
It's interesting what you say about the UK market, because it is very different from other markets around the world, particularly in Europe as well, and in particular the used car market. And what we've seen over the past 12 months has just been, I mean, let me put the question to you. What do you think about what you've seen?
Only one word to describe it: unprecedented. I was quoted earlier this year as suggesting it was like 2009, when we came out of the last global financial collapse. But I've been in the industry a little while now, James, 37 years to be precise.
You're only 25.
I know, I don't look a day over 24, do I? I've never seen a used car market like this. It's an absolute phenomenon, driven by, we've taken 1.2 million vehicles out of the new car market over the last 18 months. That's 1.2 million vehicles that can't be remarketed. That's 1.2 million vehicles where, if I look at our group new car stock today, we're down 66% year on year going into a September, okay? The new car market for July, yesterday was down 30%. The van market was down 19%. This is on the back of the semiconductor issue and other raw materials. The knock-on impact that will have on September is, in my opinion, profound. And I can see used car prices staying at, frankly, extraordinary levels, the likes of which we've never seen before, for the foreseeable future. And I don't see a great big splurge on the other side, because the OEMs can't afford to produce the product and then wait for the man with his bag of semiconductors to walk in and clip them in place. So I think as you've seen with all the updates, the industry's just found an extraordinary sweet spot, of which I'm not sure if we'll see in my lifetime again.
I mean, some dealer bosses have been telling us this week that they expect Q3 to be pretty depressed. September order take down significantly, but Q4 things could rebound back. What's your view?
I'm cautious. I don't think that, I've certainly seen no evidence that the semiconductor issue is going to be addressed this year. In one particular case with one OEM, and I guess it demonstrates my naivety. When we say semiconductor issue, and Ian Plummer from Auto Trade, who I hold in very high regard, described it as a crisis, I actually think it is now. And I think that I foolishly thought when you said semiconductor, it might be 10 of them, it might be 20 of them in a given vehicle. One of our OEM partners was with us last week here. They have 1,000 semiconductors in each vehicle they produce, and they're having to adjust the specifications of the vehicles they're offering to our guests because they can't find the semiconductors to do, for instance, a head-up display. So there's no semiconductor anytime soon, so the guest is having to compromise if they want the head-up display. I mean, it's just an extraordinary set of circumstances. I see Q3 and Q4 being really quite challenging, and I'm hopeful next year that we will see some easing of supply.
Yeah, and of course it's not just a short-term thing, this. It's got long-term repercussions, manufacturers altering their production schedules. We could be seeing the fallout from this for quite some time.
I think that's the case, James, yes, and I think that our communication with our guests and customers is the critical thing, because forward order banks are obviously buoyant, but also cancellations are also beginning to become more of an issue. And of course, what people are attempting to do if they can't source a new vehicle is purchase a used car. But in certain nearly new car case, it's over retail price to purchase one. I mean, it's just unprecedented and extraordinary. Yeah. But I think there are challenges ahead.
Yeah. Let's just get back to Cambria. So at the moment, I mean, the latest full year EBITDA was 17.08 million, putting Cambria in 14th place in our top 100 most profitable dealers list. I mean, what are your plans, short term and long term, should the deal come off?
Well, short term, you could see our half year to the end of February was very, very strong, and the strongest half year we've ever had, including a national lockdown, which just gives you some idea of the unprecedented circumstances. We're due to update the market in the first week of September for how this year will finish, which is the end of August. Short-term plan is to find our way through this semiconductor crisis and see what the world looks like on the other side, post furlough scheme disappearing, rates holiday, we're now paying a third of our rates, and we go back to full rates from April next year, agency model to deal with, and a once-in-a-century propulsion system change. So it's... You've got a lot on your plate, haven't you? I think all of us have. I think all of us have, and I think OEMs and retailers need to work closer now than they ever have been, because the first part of the crisis wiped us all out and cost a lot of money, and more importantly, a lot of jobs. I think now, I'm hoping we're into the second part of the crisis. Infection rates look to be coming down on a consistent basis, but hospitalisations are still going up, James, and death rates are climbing as well. So I think it's a time to be cautious and hopeful, and hopefully once we're through the end of 2021, we can have a little more clarity what 2022 looks like as the supply burden starts to ease a little.
Yeah. I'm going to press you just a little bit on long-term future. I know it's difficult to answer this because of exactly what you've just said, but do you see you adding more brands to Cambria? Do you see the future being in wonderful showrooms such as this, or are you going to be adopting more of an online sort of focused approach?
Our approach is very much omni-channel. I think some of the facilities that we sit in today, in a decade's time, I think they become obsolete. And I think as they become obsolete, we've got to look for alternatives to put facilities like this to work, because if we are, and I don't believe we will be, pure electric by 2030, I think that the income model changes fundamentally. And I think while we're public, our hands are tied as to how we can address that, because there's no incentive to do anything other than motor retail. I think if we're private, we can be a lot more agile and a lot more adaptable. And I think that the size of our company means we are quite agile, but with our hands tied, it's not in anybody's interest to stay where we are, in our opinion.
Yeah. Mark, we're going to have to leave it today, but thank you so much for speaking to us. I wish you the best of luck with everything, and just thank you for speaking to us.
Really appreciate the opportunity. Thanks, James, and catch up again soon.
Well, that's it for today's Car Dealer Live. Join us again very soon. Bye-bye.